Every time you tap your card to buy a coffee, you're playing a game you might not even know exists. It's a game with 4 teams, and they all wear the same uniform, just in different colors. We're talking about the big 4 banks: Commonwealth Bank, Westpac, ANZ, and NAB. You see them on every street corner. Their logos are burned into our brains, and they spend a fortune telling us they're our trusted partners in life. We see them as safe, reliable, slightly boring guardians of our money. But there's a much more exciting and profitable game happening just beneath the surface. These financial giants have developed a business model that is a masterclass in turning everyday customers into a source of endless profit through a series of quiet, clever, and completely legal maneuvers. This is the story of how they do it. We're about to open up the playbook on sneaky fees, the interest rate magic tricks, and the spectacular scandals that reveal how Australia's biggest banks have perfected the art of raking billions from Aussie pockets. So, how did the Big 4 get so powerful in the first place? It's a fantastic story, and a huge piece of the puzzle is a government rule called the 4 Pillars Policy. It was designed with a straightforward intention of stopping the 4 major banks from ever merging. This was supposed to crank up the competition and ensure a single banking giant couldn't stomp across the landscape and take over the entire market. The idea was to keep them in separate corners of a boxing ring, constantly jabbing at each other for our business, which in theory should lead to better deals and better service for everyone. But in a fantastic twist of fate, this policy did the exact opposite of what it was supposed to do. Instead of creating a fierce battle for customers, it built a cushy, protected VIP enclosure with a velvet rope. By making it illegal for the 4 heavyweights to knock each other out, the policy removed the single biggest threat they faced. The incentive to radically innovate or slash prices to gain an edge was suddenly much lower. Why start an all-out price war when you know you can never land the knockout blow by buying out your biggest competitor? The policy essentially told the 4 biggest lions in the jungle that they weren't allowed to fight each other, which just left them free to dominate everything else. It accidentally created a dream scenario for them, a market where their biggest rivals could never team up. This created what economists would call an oligopoly, which is just a fancy word for a playground where only a few big kids get to make the rules. This has allowed them to grow into absolute titans of the Australian economy. To really get the scale of this, you need to look at the numbers, and they're genuinely mind-boggling. These 4 institutions control around 3/4 of Australian home loans. That's a market worth over $2.2 trillion. This means that when you're shopping for the biggest and most important loan of your life, you are, in all likelihood, just choosing between 4 different colored front doors that all lead to the same building. Moreover, the Big 4 hold over 70% of all household deposits in the country. Our savings accounts represent a massive, stable, and incredibly cheap source of funding for them. They take our money, pay us a tiny sliver of interest for the privilege, and then lend that exact same money back out to other people as mortgages and business loans at a much, much higher interest rate. The gap between what they pay for our money and what they charge for it is where they make billions. But their reach extends far beyond that. They're the biggest players in business lending, acting as the gatekeepers of capital for the small and medium-sized businesses that are the engine room of the economy. They manage or have deep ties to many of the country's largest superannuation and retirement funds, giving them influence over how trillions of dollars in nest eggs are invested. They sell us insurance, process our payments, and run the financial plumbing that our modern digital lives depend on. Their apps are on our phones, their terminals are in our shops, and their influence is pretty much everywhere. All this power and market control essentially makes them the architects of the Australian economy. From this position, they can build a system with rules that work in their favor. It's this foundational advantage that makes their entire playbook of profitable moves possible. So, how does this machine actually make its money? Well, the real genius is that it's not one big hit. It's a collection of small, sneakily designed tactics that quietly channel wealth from you to them so slowly that most people never even notice. The first one is a story of such spectacular audacity that you almost have to admire it. The 2018 Banking Royal Commission, a massive public inquiry that put the whole industry on trial, uncovered a widespread practice that became known as fees for no service. It's a pretty simple concept. All four major banks were charging hundreds of thousands of customers for professional financial advice that was never, ever delivered. People were paying thousands of dollars a year for a dedicated financial advisor to help them manage their money. But in reality, the advisor did nothing. Yet, there was an automated debit from the customer's account year after year. The fees didn't even stop when the customer died. The commission found case after case where a family had informed the bank of a loved one's passing, yet the bank's systems just kept on billing the deceased person's estate for financial advice. When this all came to light, the banks were ordered to pay back over $5 billion in compensation. It was a huge number that made the headlines, but for institutions that make many billions in profit each year, it was just the cost of doing business. No one from the executive suites went to jail. They issued some carefully worded apologies, promised they'd learned their lesson, and the game continued. When it comes to interest rates, the Big Four have perfected a lopsided system that always works in their favor. It's a simple principle they all follow. Any change that helps you, like a rate cut, will float down slowly like a feather, but any change that costs you, like a rate hike, will shoot up instantly like a rocket. In Australia, our central bank is called the Reserve Bank, or RBA. Think of it as the one that sets the financial temperature. When the RBA changes its official rate, all other banks are supposed to follow. But how they follow is where the game is played. When the RBA makes money cheaper by cutting rates, your bank suddenly moves in slow motion. They'll wait for days, release complicated sounding press releases full of fancy excuses, and then maybe they'll pass on a tiny bit of the discount to your home loan. They often decide to keep a healthy slice of the savings for themselves instead of passing on the full amount to you. However, when the RBA raises rates and makes money more expensive, your bank moves at lightning speed. An email announcing your higher mortgage repayments will probably hit your inbox before the RBA governor has even finished speaking. The price hike is immediate, and you can be sure you'll be paying the full amount right away. This lopsided game gets even worse when you look at your savings account. While your home loan costs are going up, the interest the bank pays to you for holding your money stays glued to the floor. It earns almost nothing, sometimes even less than the rising cost of living, which means your hard-earned savings are actually losing purchasing power over time. When you control 3/4 of the home loan market, you get a designer maze that everyone has to run through. For years, the Big Four created a culture where the main goal was to load people up with as much debt as possible, whether they could afford it or not. This gave us the wonderful era of the liar loan. The Royal Commission found that banks and mortgage brokers were often ignoring a person's real living expenses. Instead of looking at what someone actually spent, they used a ridiculously low one-size-fits-all benchmark. This clever bit of paperwork made people look much richer than they were, which allowed the bank to approve them for a much bigger loan. This trapped countless Australians in homes they couldn't truly afford. Also, the bank and the broker could collect a bigger commission. The whole system was a masterclass in rewarding the wrong behavior. Mortgage brokers are supposed to be your independent guide through the jungle of loans. But the banks paid them in a way that encouraged them to act like double agents. The more you borrowed, or the more expensive the loan product they sold you, the more money the broker made. The person you were trusting to give you unbiased advice had a massive financial incentive to push you into a product that was better for the bank, not better for you. Then there's the humble credit card. This simple piece of plastic has been engineered into one of the most effective profit-generating gadgets in finance. The Big Four continue to issue cards with absolutely eye-watering interest rates, many of which are still around 20%. The strategy is deceptively simple. First, they market these cards to everyone, especially those who can least afford them, like students and pensioners, selling the dream of convenience and security. Then comes the trap. The fine print of a credit card agreement is a work of art, full of hidden clauses and penalties. There are fees for paying late, fees for going over your limit, and special high rates for taking out cash. The most brilliant trap of all is the backdated interest on interest-free periods. If you fail to pay off your entire balance on time, even if you're just $1 short, the bank can cancel your interest-free deal and charge you interest on every single purchase right back to the day you made it. It's a system designed to turn one tiny slip-up into a major financial headache, creating a cycle of debt that's very profitable for the bank. This brings us to the most modern and invisible play in the book. The banks have realized that in the 21st century, your data is worth more than gold. Every single transaction you make is a little clue about who you are. The banks are gathering all these clues, billions of them, to build a stunningly accurate picture of your life. They know where you shop, what you buy, your good habits, and your guilty pleasures. And they're putting that diary to work. Banks partner with powerful data analytics firms to find patterns in your spending and then use those patterns to sell you more things. Those helpful budgeting tools inside your banking app are a fantastic example. They encourage you to neatly categorize all your spending, which helps the bank's computers understand you even better. This information is then used to target you with pinpoint accuracy. If you're spending money at hardware stores, maybe you get an offer for a home renovation loan. If you're paying for car repairs, maybe a car loan offer pops up. They're using your own behavior to craft the perfect sales pitch to get you into more debt. If the banks' everyday playbook seems a bit cheeky, the major scandals are on another level entirely. Each of the big four has had moments where their ambition got the better of their judgment, creating headlines that were as spectacular as they were shocking. Commonwealth Bank had its squeaky clean image completely torched when they were hit with a massive $700 million fine for failing to report over 53,000 suspicious cash transactions, which allowed criminals to launder millions of dollars through their intelligent deposit machines. Then their insurance arm, CommInsure, was caught using dodgy and outdated medical definitions to deny claims to very sick customers. The scandal, exposed by whistleblower Dr. Benjamin Koh, revealed a culture where legitimate claims for things like heart attacks were rejected based on medical definitions from the 1990s. But the list doesn't stop there. CBA was also embroiled in a series of financial planning scandals. Their advisors were caught forging signatures, charging exorbitant fees, and pushing customers into risky investments that wiped out their life savings, most infamously the collapse of Storm Financial, where the bank had approved massive, inappropriate loans to elderly clients. Not to be outdone, Westpac went for the all-time high score, copping a mind-boggling $1.3 billion fine for 23 million breaches of anti-money laundering laws. The most horrifying part was that these failures included neglecting to properly monitor payments linked to child exploitation. The sheer volume of breaches and the gravity of what their systems failed to detect led to the resignation of their CEO and showed a catastrophic failure of oversight. Westpac was also a key player in the bank bill swap rate rigging scandal. This is where traders from multiple banks were caught manipulating a key interest rate to boost their profits on the trading floor. For their part in this scheme, Westpac was hit with a significant fine from the corporate regulator, ASIC. Meanwhile, ANZ got into hot water when senior figures were accused of criminal cartel behavior for allegedly colluding with other banks to manipulate the price of their own shares. They also perfected the art of blaming a few rogue advisors for a sales culture that was pushing people into products they didn't need. Like Westpac, ANZ was also heavily involved in the BBSW rate rigging scandal. They ended up paying a $50 million fine for their role in manipulating this key market rate. Additionally, they faced severe criticism over their treatment of rural customers through their takeover of the landmark loan book, where many farmers accused the bank of aggressively and unfairly foreclosing on their properties during tough times. And then there was NAB's major scandal, the Introducer program. Basically, they were paying people like tailors and gym instructors cash under the table to bring in new customers for home loans. Because these introducers weren't qualified, it led to a wave of dodgy loans being approved. The Royal Commission was particularly tough on NAB's leadership, calling them out directly in the final report for their terrible attitude and for not owning up to the problem, which ultimately led to the resignation of both their CEO and chairman. This brings up a fascinating question. How do they all manage to dance to the same tune without a conductor? The answer is a brilliant piece of game theory called Tacit Collusion. It's an unspoken understanding that allows them to coordinate their moves perfectly without ever having to speak to one another. It's like having 4 petrol stations at the same intersection. When one station raises its price, the other 3 see it immediately. They know they can all raise their prices together and no one will lose business. In fact, they'll all make more money. No one needs to call anyone. It's just the logical, profitable thing to do. This is exactly how the banks operate. One of them will raise their mortgage rates out of the blue. Within a day or two, the others will follow with almost identical increases. One will launch a new account fee, and before you know it, that fee becomes the new industry standard. They simply follow the leader because it's good for all of them. It's a perfectly coordinated dance that keeps profit high and real competition low. The end results of this brilliantly designed game is a quiet, continuous transfer of wealth from the pockets of ordinary people to the shareholders of the Big Four. We're talking about billions of dollars every single year. This money comes from the junk insurance you were sold, the extra interest you pay on your mortgage, the fees for services that never happened, and the pathetic returns on your savings. It's a hidden tax on just living your life. But the real genius of the system is how it keeps you from leaving. Switching banks is designed to be just enough of a hassle to put you off. You have to move all of your automatic payments and tell your employer your new details. It's boring, and the banks know it. They also know that since they all offer a similar deal, there's little motivation to go through all the trouble. And so, most of us just stay put, funding the whole machine through our own inertia. So, when you put it all together, the picture becomes incredibly clear. The friendly neighborhood bank is an amazing marketing concept, but the reality is that you're interacting with a highly efficient machine designed to generate profit. When you strip everything else away, the real relationship becomes clear. The banks operate a sophisticated farming system where your money acts as the seed, your data serves as the fertilizer, and your loyalty ensures a profitable harvest year after year. And the most amazing part of all is that even after everything that's come out, these institutions are still some of the most trusted brands in the country. That shows you the incredible power of familiarity and convenience. But knowledge is power. Once you understand the game, once you see the playbook, you're no longer just a piece on the board. You can start to make smarter moves, you can question the fees, you can shop around for a better deal from a smaller lender, and you can demand more. Once you know the rules of the game, you can finally start playing to win. But what do you think? Are the Big Four banks just playing the game, or is their dominance a systemic problem that needs to be addressed? Drop your thoughts, personal banking stories, or any frustrations you've had in the comments below. We want to hear your side of the story. And if you found this deep dive valuable, make sure to like, subscribe, and hit the notification bell so you don't miss the next one. Thank you guys so much for watching, and as always, stay curious.